following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, and I hope all of our listeners out there are thriving in this ultra volatile environment that we find ourselves in, and we hope the listeners to this show are among the savvier of the vol traders, so you are indeed faring well in this environment. My name is Mark Longo from theoptionsinsider.com, as well as many of the programs on the ever-expanding Options Insider Radio Network. And I am joined today by two of the usual suspects, starting off with my boon companion, the yin to my yang, none other than Don Schlesinger. And Mark, you and I will have to come up with a nickname for Don later, because Don does not have a nickname yet. Only person on the network.
Well, we could just call him Don the Don Schlesinger.
There we go. Don Corleone Schlesinger.
Don the Don Schlesinger.
Don,
I like it.
I like it. Don, welcome back to the show, sir.
Always a pleasure. Happy to be here, Mark.
How you like that nickname, Don the Don?
Well, you know, it sounds rather nefarious, but anything is good.
So do you. I don't know if you've heard how nefarious you sound, Don, most of the time.
I don't know if Volex Compliance will sign off on that nickname.
You know the old saying, say whatever you want, but just spell my name right.
And listeners, that other voice is none other than the Greasy Meatball, a.k.a. Mark Sebastian from OptionPit.com, joining us live once again to What Do We Owe the Pleasure, sir?
I have completely rearranged my Friday schedule so that I can make these live from now on.
Our listeners will appreciate it, and so will Don.
Yeah, Don the Don? Well, that was the thing, is I got an email from Don the Don, and it said, hey, I'm sick of this recorded stuff. I want you there live. And
I got an offer you can't refuse.
Yeah, when the Don says something, people listen, myself included. So that was the story there.
All right, and with the team assembled and live, fully live for a change, we're going to dive right into the Volatility Review.
It's time for the Volatility Review.
And welcome to the Volatility Review. This is indeed the portion of the show where we, surprise, surprise, run down the volatility action from the past week. And it was indeed an active one, Mr. Sebastian. We saw quite a bit of movement in the old VIX cash as well as in the VIX futures. And as we discussed on one of our other programs and have been discussing for a while, and also on this program to a degree, just the nature of the VIX futures versus the VIX cash, and how so many of the long-dated contracts in the VIX futures were predicting this sell-off in the VIX cash that hadn't really materialized and is finally starting to materialize to a substantial degree over the past week or so. So I'd imagine that's the bulk of what you've been watching this past week in the terms of volatility.
Well, in terms of equity volatility, yes. I've been keeping an eye. If you look at vols across the board, other than bonds, vols are in. You know, you've got S&P volatility in, you've got gold volatility in, you have just about every single measurable volatility getting beaten up a little bit, as they should. And then, you know, out there is bond vol because, and even that's coming in a little bit, but bonds are just astronomically expensive right now. And, you know, that's naturally going to keep that vol a little elevated. But, you know, the real story is they're crushing this stuff, and it's real interesting. We actually saw just today VIX futures enter what we call contango. It kind of. So you've got the cash below September, September below October, but October is when the Eurozone is making all of those decisions. So then you've got October higher than November, November higher than December, and then you have December lower than January, and so on and so on. They're obviously pricing in some of the Christmas holiday as well. So VIX term structure really screwy. Gold volatility, as it should be, has been getting thwacked. It was just incredibly expensive for a while, and now thankfully has calmed down a little bit. And then if we look at bond vol, just kind of crazy.
Is that your official opinion?
That's
I didn't realize you were a rabbi in your spare time.
That's the hidden Jewish guy in me. That's
a technical term. We don't really throw around those terms too often here, but that's.
You can find that in Natenberg, I'm sure.
Yeah. Yeah. No, I mean, bonds are just sky high expensive, and the vol is really high until, there's kind of I like to call it the elevator of panic. At the top is gold prices. The next floor is VIX, and then the next floor, or volatility within kind of products, gold, whatever, option volatility, we could say. And then the next floor down, and really the bottom floor, is bonds. So when I see bonds start to sell off, if and when that happens, then I will buy this rally. Now, looking at currency, just to kind of bring it back, because really part of the reason why bond vol is so expensive is what's going on with all over in Europe, which really relates directly to currency. We can see that, the last time we were on, Bob and I were discussing the fact that in the short term, when realized volatility has hit that medium, you and I were talking about this too, when realized volatility has hit the long-term mean, until this crisis gets its act in gear, that's almost a buy signal. Right now, believe it or not, 10-day trailing volatility is higher than option implied volatility on the currencies. So it's just kind of interesting what's going on. Don, what are your thoughts on realized volatility?
Well, of course, that can be extremely important because it just doesn't happen terribly often that you get this crossing of the lines of implied and realized volatility. And so when you do sense that the realized volatility has actually been higher over a period than implied, you recognize very quickly that that's not a normal state and is very unlikely to persist for any length of time. Of course, the resolution as to how it plays out, does that mean that implieds are now going to drift higher, or does that mean that realized, which has spiked up, is going to come in dramatically, is always the $64,000 question, and your crystal ball isn't always so clear as to exactly which way it's going to play out. The only thing that you kind of know with almost certainty is that it won't be too long before implieds are greater than realized once again, but you're not exactly sure which way it's going to actually occur.
While we're on the subject of currency vol, earlier this week, actually, Don, I was in New York for the Futures Industry Association / Options Industry Council. So it was a double industry event. So it was a very highly industry crowd. And I learned two things when I was there. One, the Vol Views is quite popular with that crowd. Quite a few people pulled me aside to mention that they were listening to the show. And that B, a lot of people after the last few shows started digging into the vol contracts to investigate that ratio, 1 by, I believe 2.5 quasi-arb spread that we put on there in the 3 vol versus the 1 vol. So I think we sparked a lot of interest in potentially arbing these contracts down the road.
Probably never be available again as long as we
It was
live.
a one-time, you missed your chance, but theoretically it's very interesting. So I thought I'd let you know that if you saw any spike in activity there, it's because of us and because of the work we're doing here.
Very good.
But yeah, a lot of people trying to dive into the 3-vol versus 1-vol quasi-arb.
Yeah, I mean, if you look at the I'm looking at the 1 month at the 1-vol right now, and it settled yesterday at almost 1460 in the October. The October contract almost settled at 1460. That's pretty up there, isn't that, Don? I mean, what's been the highest settlement for that contract?
And here's the concept there, as I'm sure you kind of well understand. Unlike VIX futures or anything that is purely implied volatility, we always talk about the fact that vol contracts have this dual nature, that once the realized volatility period has started, there is the part where volatility has already been plugged into the formula and logged, and therefore what we call the partial realized volatility. And then there's the stub, the part that's left that still reflects sentiment and that might more resemble, VIX-like pricing for implied or for future or for forecast. Well, we're very, very early into both the October 1-vol and the December 3-vol, which is to say that the majority of the pricing right now of those contracts is more VIX-like and implied-like in nature than it is due to the actual historical or realized volatility that's already priced into the contract. So what you've got for both of these contracts that began this past Monday is a partial volatility for 4 days of just about 12%, 11.99. And you've got a forecast from Robert Engel at the Volatility Institute for both of these contracts to expire very close to that range, 1210, 1204, respectively. But that doesn't stop the marketplace from pricing them and trading them today at 1458 and 1483, respectively, the settlement prices from last night, again, with that continual bias of a few percentage points of implied volatilities generally being higher than historical volatilities and reflecting so in the early trading when these contracts first enter their realized volatility period. So again, to use that term that we've coined, the inferred volatility, if you got logged volatility of 11.99 and you're trading at 14.58, that would imply that we'd have to have over 15 volatility from today going forward in order to justify the settlement price of last night. And of course, you can make your bets accordingly and say, I think it's too high, I don't think it's too high, but that's the understanding that traders should have as they look at the interrelationship between the settlement price, the partial volatility that's already been realized, and that implied or inferred stub, which is more VIX-like in its component.
Whenever you say stub, I always think of, for some reason, the hanging chads, the stub votes from back in 2000. It's not exactly a pretty image, but you mentioned the discrepancies between the implied and the realized, and I know there are, as of yet, no announced plans to do anything like this from you guys, but down the road, it will be interesting to see when and if you guys do also add some broad-based equity indice type content to your vol contracts to see the interplay between those contracts and some of the other implied volatility equity index contracts that are out there right now. I think there'll be a lot of very interesting ARB and a lot of very interesting spreads that we can do on some of these very liquid contracts. And obviously the euro also liquid, but I think a lot of our listeners are also far more versed in the world of equity volatility. So it'll be interesting to see what we can do and what sort of ARBs and spreads and relationships people concoct when and indeed if that ever comes to pass, sir.
It's definitely a when, coming to a theater near you quite soon.
Oh, that's good to hear.
Exciting.
I'm sure a lot of our listeners will be excited by that. I didn't want to put any words in your mouth, so I just left it very vague.
The concept is fascinating to be able to, imagine being able to bet And the nice thing is that the settlement actually makes a lot more sense on an equity contract than something where it's based on, where you really are trading an implied volatility, but the settlement, much more like an option, goes to a real price as opposed to kind of an opening print based on this and that. Not that the VIX futures don't have, lots of use, but this has some really interesting characteristics that until recently, that currently have to be done off floor.
Right. And so it's been the purview of over-the-counter vol swaps and variance swaps, and bringing that concept to an exchange, transparent, listed trading is really what our fundamental premise is. And so the ability to settle to something tangible that actually can be calculated by a formula is obviously, as our listeners have heard in the past, the entire premise of the volatility exchange and the products that we hope to roll out.
And speaking of rolling out, we're going to roll out of the Volatility Review and roll right into our Volatility Viewpoint segment.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and welcome to the Volatility Viewpoint segment. This is, of course, the portion of the show where sometimes we feature a guest and sometimes just Don and I and others, in this case, Mr. Sebastian, pontificate about some volatility topic and or options topic at length. And Don and I, as we were discussing what the topic should be for today's show, I hear a little birdie tells me that you received an interesting email from one of your cohorts back in the, say, your card slinging days, and he had an intriguing question. So why don't you illuminate our listeners on what your friend asked you and how that pertains to volatility and options, sir?
Yeah, I got an email actually that was referred to me from the publisher of my blackjack book, and sometimes people who want to get in touch with me and may want to ask investment questions kind of go an end run and find me through other channels. But the email that I got really brought up a fascinating topic that, I have a little background in, having studied and a friendship with Ed Thorpe and talking about the Kelly Criterion. Without getting too heavy into the mathematics, I thought I'd lay it out for our listeners because I think it's very important and it has an obvious and absolute tie-in to mitigation of volatility and managing your volatility and variance risk, whether you're an options trader, a hedge fund manager, portfolio, whatever the case may be. So his question basically was fairly simple to enunciate, but not always so easy to answer or understand. He was fiddling around with different trading systems and strategies for trading. In this case, it happened to be FX. And he said, I've hit upon what look like two promising variations on trying to get an edge trading. And he said, what I've noticed is the fundamental difference between the two is that with one of them, my payoffs, my ratio of a winning payoff to a losing one is rather modest, but I'm very consistent and I have a high percentage of winning trades. And with the other one, my payoff is rather impressive, a winning payoff to a losing one. It's a multiple of a losing one, but understandably, that's a little bit harder to achieve. And so my winners are less frequent with respect to my losers. And yet, when I crunch all of the numbers, it seems that the two are giving me about an equal return on investment. In other words, if I perceive an edge here, whether it's 10% or 15%, seems to be like about an equal edge for the two of them. So the question was, that being the case, should I prefer one of these two approaches to the other? If I'm getting the same return, it would seem that it kind of didn't matter which one I would use, but is there some mathematical principle or some reason why I ought to prefer one to the other? And he was very surprised by my answer, which is, yes, you should absolutely prefer one to the other, because if you allocate your funds properly and you size your bets or your investments accordingly, you will in fact make a great deal more in the long run with one approach than the other. And this was a revelation to him, and he was rather surprised to hear that, and listeners may be as well. And the answer is to favor that approach that has the greater number of winning trades, the higher percentage of winning trades, even though the payoffs for those trades may be somewhat more modest with respect to the other system. And a good analogy and an easy way to understand why this is so has to do with the same type of concept. Suppose you had a system for the racetrack and for picking horses, for example. And in one case, it was based on favorites. You won a great number of your bets, but when the favorite came in, it was a modest payoff of $3-4 for your $2 wager. And in the other one, you had a long shot system where you might not have won one bet out of 20 or 25, but when that one came in, it might have paid, $50 or something like that. And you say, well, which one, if I'm getting the same percentage return, maybe 10% or so, any reason to favor one over the other? And the answer again is yes, really, there is. And you have to go with the one that limits your volatility, that limits your fluctuations, your drawdown, your variance, and gives you consistency. Because it turns out that there's a fundamental principle of investment that's known as the Kelly Criterion, or optimal F, or the critical fraction that you should wager of your entire bankroll when you perceive an advantage, and tells us that we're supposed to put on any one trade or investment or race or bet or whatever you want to call it, that percentage of our bankroll that is represented by the edge, but then you temper that by the ratio of the payoff of a winning bet to a losing one. And so you've got a numerator that has your edge or your advantage in it, but then you've got a denominator that has that ratio of a winning payoff to a losing one. And the longer shot that it is, the higher the amount of that winning payoff. Rather than being a good thing, it's actually a bad thing, because it's limiting or lowering this critical fraction that you can allocate to any particular such trade or such bet. And as a result, if two people have exactly the same bankroll, exactly the same amount of money to commit to the particular strategy, then the person whose Kelly fraction is the largest by virtue of this edge divided by ratio of winning payoff to losing one is going to make much, much more money and grow his bankroll much faster in the long run. And when you think about it for a minute, there's some absolute logic to it, and that's because when you win your bets or your trades with alarming regularity, then you don't ever really have losing streaks, any types of drawdowns or long periods of time, droughts where you keep losing trade after trade after trade. When you have a long shot system, which pays a big number when it comes in, but your ship comes in very infrequently, you often go for very long periods of time with losing trade after losing trade while you're waiting for that winner to come in. So it's clear that you can't afford to allocate the same amount of capital to that second long shot system on a per trade basis as you can to the first one, because you're going to risk going broke with much too high a probability. And in this game or in any other, the key is you have to be able to turn on the lights tomorrow morning, and you have to be able to stay in the game.
Yeah, stake management.
What's the old saying? You may win the war, but if you lose too many battles, you won't get to finish the war anyway.
And so this is an extremely important principle, and one that has rather sweeping ramifications for all discussions about volatility and Sharpe ratio. I've often had this discussion with a lot of people, and that is, if you have one manager who can promise you a 10% return and the other one can promise you a 12% return, which one would you go with? And people will say, well, that's obvious, I go where the greater return is. And I say, well, I didn't tell you the whole story. The first guy gets his 10% return, and he has only a 20% standard deviation, annualized volatility. Second guy gets his 12% return, but he has a 40% annualized standard deviation. Now, which one do you go with? And of course, if you want to put it in quotation marks, the quote right answer is that you should really prefer that first manager with the 10% return but only the 20% volatility to the second one who's getting you, 2% more on the return but with double the risk.
I would just catch the second manager in a good year, then move my funds on a bad year.
Manage your timing.
Just tell me the times when volatility is going to be with me rather than against.
Yeah, that's exactly what I would do, Don.
And so that's the old Will Rogers joke. The stock market's very easy. Just pick a stock that you like and buy it. When it goes up, sell it. If it doesn't go up, don't buy it.
Will Rogers was a very, very bright man.
Yeah. Well, that's actually, Mark, that brings up a good point, though, Don just brought up about and why I actually like derivative contracts so much is that when you're trading options or futures, you don't have this falling in love concept that a lot of people get with stocks. There are
it's kind of hard to fall in love with a 30 delta vertical.
Right. We were talking yesterday about RIM, Research in Motion, and how many Canadians own it because they're like, oh, RIM, it's our national company. And no one ever says, oh, the RIM September 32.5 calls are our national company. No, I mean, that's the neat thing and playing stuff like you want to go long the euro. Well, maybe using something like a vol contract future makes more sense, or an option trade makes more sense than going in and buying a bunch of euros because, the concept of things going up forever is something people can't seem to get past. I could sell my Apple, but it might go higher. I could flip my euros back into American currency, but it might go higher. Or it might sell off from $1.46 down to $1.36, and you just blew a bunch of money. What Don is talking about is so important. His common sense, well thought out. Hey, do the stuff that is consistent, that pays, is the right way to go.
And so it's really very interesting because I had a friend when I was at Morgan Stanley who, when we would talk about what's known in the industry as risk-adjusted returns or Sharpe ratio concept, that you need to be cognizant not only of the numerator and the payoff and the edge and the return, but you really do have to pay attention to the denominator also and the risk that you're taking in order to achieve that return. And this person kind of poo-pooed that and wrote an article that I never forgot in terms of the title. It's just something that stuck with me all these years, and it was, "You can't eat risk-adjusted returns." It was a terribly catchy title, but of course the premise was, all that really matters at the end of the day is how much money you make, what the return is on your investment. But it really does beg the question, because what it really doesn't understand is that for a fixed amount of capital or for a bankroll that you have to commit to a certain endeavor or project, you are going to make the most money and you are going to eat the returns, where you can grow what's called the geometric or the logarithmic growth of your bankroll the fastest. And using this Kelly criterion, or sizing your trade wager, if you will, or investment accordingly, is what mathematically grows your log wealth, or the log of your bankroll, at the greatest rate. It allows you to achieve any particular goal faster on average than any other. It allows you to accumulate wealth faster than any other. And lest our listeners think that there isn't an extremely impressive body of literature on all of this, I've just bought a brand new book that was edited by actually 2 out of 3 people whom I know. The first name is Leonard McLean, Lean, but the next 2 are Edward Thorpe and William Ziemba. And Ed Thorpe is, to those who may have known Princeton, Newport, and Oakley Sutton.
Princeton and Newport, aren't those cigarette brands?
Well, they're actually the names of 2 towns, one in New Jersey and Newport Beach in California. Where he and his partner, Jay Reagan, were located when they ran the fund. But some people know the name of Ed Thorpe also as the person who, all the way back in 1962, was the first person to lay out the theories of card counting and blackjack when he wrote Beat the Dealer. But what people often don't know is that he also wrote a follow-up piece called Beat the Market, where he started talking about arbitrage possibilities, and founded Princeton Newport, which went on to make hundreds and hundreds of billions of dollars for its investors. But in any event, Thorpe is one of our premier mathematicians and financial engineers. He actually had intuitively worked out the Black-Scholes formula even before it was published by Black-Scholes and Merton. And those who know Paul Wilmot and his magazine in London, and the website, which has spectacular financial advice and discussions, Thorpe had a whole column there called What I Knew and When I Knew It, when he writes about, his kind of code development of the Black-Scholes formula. But I mention it only because I'm holding this book that I can also use for weight training if you lift it over your head. It's 853 pages, and it's called The Kelly Capital Growth Investment Criterion. It's published by World Scientific with the 3 editors, McLean, Thorpe, and Ziemba, that I just mentioned. And it is a collection of everything you'd ever want to know about applications of the Kelly criterion to investment. All the papers that have ever really come down the pike, literally hundreds of them, since 1956, when Kelly, who actually worked for Bell, a telephone company, actually enunciated this concept of transfer of information over telephone lines and the most efficient way to do it, and later became introduced to wagering systems and what have you.
It's funny you mentioned that, because I'm familiar with the Kelly criterion, but I've always heard it in the gambling context. I don't hear it that much in the investment, because it's often referred to as measuring events that have the same probability of occurring and the same payout every time, which is something you can easily replicate in a gambling scenario, making the same bet over and over and over again. It's a little more difficult to replicate in an investing scenario. I mean, obviously you could probably go out and write the same 25 delta put every time. That would give you the same rough payout of but then you have volatility factor, you have different premium levels. You're certainly not going to get the same payout every time.
No, the biggest impediment to the application of the Kelly criterion to portfolio investment or anything having to do with finance is really along the lines of what you've just mentioned, and that is getting the estimate of what your advantage is, and the fact that that's never really quite as determinable, if that's a word, as it is with gaming. And so if you perceive an edge that can be mathematically worked out in a gaming situation, and you actually can do the math and determine what your advantage is. Obviously, if I have a biased coin and, I know it comes up heads 52% of the time and I'm allowed to bet on heads, well, then 52 minus 48, I've got a 4% edge, and I know that edge with certainty. But, if I'm going to engage in an option strategy or pick a portfolio of stocks, and I want to try to estimate what kind of a return I'm going to get or what my advantage is, that's a lot less easy to calculate than the example that I just gave. And yet you need to try, because the whole concept is if you've got a bankroll and you've got money to invest and you want to know how much of that bankroll you ought to invest per activity, whether it's a trade or you're managing a portfolio, whatever the case may be, you really need to try very hard to assess what your overall edge is and what the volatility or the risk is, so as to best allocate your funds in the most favorable manner. And so thousands of pages have been written about portfolio management and investing, and lots of scholarly mathematical papers incorporating this concept of the application of the Kelly Criterion to financial markets, as well as to the wagering situations that you mentioned, Mark,
including 800 pages that you hold in your hand again there. So Don,
it's a good thing that thing's not 853 pages, otherwise I wouldn't read it. But now that I know it's only 852,
you're
all
good
over
there. That falls under your ceiling for reading level.
Well, you know how with running backs in the NFL, they've got the rule of 355. So if they carry the ball 355 more times or more, their career is on the way down. I have the rule of 852. So if a book has more than 852 pages, it's too long. But
it's really funny. I'll say Marks to both Marks at once. The very last paper in this book that begins on page 789, just to kind of tie the entire thing together, is by Ed Thorpe. And it's important to know where it was published: in the Handbook of Asset and Liability Management. And the name of the paper is The Kelly Criterion in Blackjack, Sports Betting, and the Stock Market.
There you go. It's ubiquitous. Like it. You can use it for everything.
I think that comes full circle to summarizing just about everything we've been talking about, at least for a few minutes.
Sir. So listeners, if you're interested, you should definitely pick up that book, all 853 pages. It's a weighty tome. Maybe there's an ebook version, a little bit easier on your back, but I put it on your Kindle. But yeah, indeed, you can investigate more of some of these various applications of the Kelly Criterion across everything, including sports betting, apparently, as we learned in that final footnote there. So the Kelly Criterion, and use it for everything.
The bottom line of all of this is it's really kind of fun, because when you appeal to people's intuition about something, it's not intuitive or easy to know what the answer is. So if you said to somebody about that bias coin 5248, so it's going to come up heads 52 times, and that ahead of time. So, gee, I'm going to make money here, You say, well, here's $100. Go devote it to this game and start to make bets on this particular proposition. Well, if you've got an edge, the way to make the most amount of money, if you're just looking for the pure greatest dollar return, is bet it all. Go bet the $100 on it. What happens there is that if millions of people do this, just about all of them go broke, because you can't win every bet forever. And so eventually, you could have a tremendous advantage at something, but if you overbet with respect to your bankroll, so people realize if I give you $100, to make my first bet $100 would be ridiculous. And then you say, well, maybe I'll be really conservative, and I'll bet $1 on each of these. I'll subdivide my bankroll into 100 parts. You say, well, you could do that. It's rather conservative. I'm sure you'll make some money, but it might take a while, grinding out at that 4% edge for it to show and for you to really be profitable. So, the answer is to what's my optimal bet? what ought I be betting on in this game? And the answer here is 4%, or $4 per flip of the coin just isn't something that's instantly intuitive or apparent to most people. But again, not to beat a dead horse, it has far-reaching ramifications in many, many, many aspects of any kind of advantage investing. And most people invest because they think they perceive some sort of an edge or some sort of an advantage. Otherwise, why would you do a trade in the first place? And the next question as to how much of your funds you ought to allocate to that particular trade is something that people spend a whole lot less time analyzing than perhaps they ought to.
It's all about staying in the game. The longer you can stay in, the better your chance of actually winning. All right, and that's going to do it for our Volatility Viewpoint this week. And now we're going to roll right into our Crystal Ball segment.
And now we take a look at the crystal ball.
And welcome to the Crystal Ball section. This is where I prognosticate wildly and Mark and Don pull me back from the ledge. Now we're actually going to kick things off with our volatility pit reporter, good old Mr. Mark Sebastian, who's joining us live throughout the show today. And Mr. Seabass, I know we've been talking on and off again about the inexorable decline of the VIX as it moves towards where the long-term futures have been predicting. And I know you had some bets to the downside in VIX. You've since rolled those out a little bit.
Just
a few.
A little bit. Yeah, I've rolled them into a little long-term, but I'm still super short. Yes.
Became a quote-unquote long-term investment for you.
It became something where I wasn't sure. I still think the October contract month is going to be tricky, but it looks like it's clear sailing at least until they start having all these discussions in Europe over the next couple of weeks. But that doesn't mean it's necessarily safe trading out there. I think the VIX below 30, most vol indexes below 30% are too cheap right now, just because of the potential upside risk. But, I think next week's going to be pretty relaxed, believe it or not.
Yeah, these contract levels, especially what we're talking about with the SEP and OCC, little discrepancy there makes it a little hard to gauge what exactly the market is leaning for the next few months.
Well, it looks like they're guessing nothing nothing for next week, and then a rocky October.
Oh, good old October, always a rocky month.
Rocktober, as we used to call it.
So you think you're going to get your VIX below 30, maybe just a quick dip, then back to the upside?
If it was going to happen, it would happen on probably Tuesday. But I don't know if it's going to happen or not. I'll be very interested to see whether it does.
We haven't done a CBOP update in a while. How is that one still running? Are you still compiling the CBOP on a regular basis?
Of course I'm compiling this.
I forgot you're getting all those licensing fees for the CBOP, so you have to.
I know. Well, the problem is the skew index is only printed.
Yeah, it's a daily index.
Yeah, I mean, it's up there. Right now it's at about 36 and change. So if they update it dynamically, it'd be a lot more use to me. The fact that it's just at night kind of bothers me. It bugs me. So... But once we get the vol contract future, then I'll be able to use. I think that actually that realized vol relative and that versus skew may actually turn into something that'd be really usable. Can you imagine a combo of a realized volatility contract and then judging skew? That'd be a great thing to use as a bet. So when you see that skew index explode, then you start making bets on realized volatility. Might be really interesting.
Way to turn it to the realized vol contract, sir. It's almost as if you've done this before.
I'm like a realized volatility machine. So.
Well, we're going to have to get you some ammunition just as soon as possible.
And by that, you mean shares of Volex Corporation?
Well, that too.
And Don, speaking of Volex and the old vol contracts, what is the outlook going forward for the old Eurovol contracts? Obviously, the period of ARB availability is behind us, but we have some new contracts running now, and maybe we could find a new way to exploit their relationships.
Well, let's look at the outrights and just I'll go out on a long limb, not a short one, but again, at the beginning of these contracts, where, as we mentioned earlier in the show, there's a somewhat higher weighting of implied pricing than to the actual calculation or realized, we've got mid 14s to upper 14s in last night's settlement prices, and yet we've got both the short-term realized portion at just under 12 and Volatility Institute predictions also right around the 12.1 range. So I'll go out on my usual limb of saying that in a situation like this, I'd prefer to sell that higher implied driven volatility and take a chance that it will come in somewhat. We certainly just had a very volatile period for the euro. I'm not a Forex trader, but I had read that 1.37 was a critical level that should not be breached, could bring on even more volatility. We breached it very shortly and then it popped back up again. So it's possible that some of that recent volatility is obviously driving the current pricing levels. So I'll go out on a limb and say that's going to come in a little bit.
You know what, Don, I'm with you. Looking at that future, I think I'm a buyer of that contract below 12, and I'm a seller of that contract above 14 and a quarter. That's kind of my. If I was making markets, that would be my market.
3 month December. I don't know, what am I looking at? 1 month October. The current market is 13.5 at 14, down 70 cents. And 3 month December, 12 and a quarter at 3/4, down $2.24 from
bananas.
the settlement yesterday.
Wow. So that's almost, I don't know what you call it, but that seems like a real decent spread. The 1-3 right there, almost, right? You know, if you consider that we've been basically bouncing off of 12 this whole time, does it make sense to sell the front and buy the long term in this case?
Well, I mean, again, it's the same type of calendar spread you mentioned the other day with just options, and it's always the trade-off between knowing that the volatility of volatility and the volatility of that 1 month, is close to 80-90%, whereas the volatility of the 3 month is only 20 some odd percent. So you go ahead and do it, but that if something really pops, it's going to smack you in the near term a lot more sharply than the far, and that's the risk reward, that's the trade-off.
Mark it down. What do you think? How do you think this would work out as a combo strategy against options? So imagine you did a short time spread against the kind of this calendar spread. How do you think that trade would work out?
Have to give that some thought. That's an interesting one, to actually have two time spreads, one with the actual volatility and one with the options, which of course has a component of volatility, but also obviously gamma and price related as well.
You get a little more bang for the buck and a little more variables in the option side of that, obviously, because it's not a pure apples to oranges. It's apples to oranges and pears and grapes that you're kind of throwing in there.
I think that could be a really interesting spread if you executed it the right way.
There's the $8 million question there.
There is the golden goose that everybody was waiting for that just popped in at 59 minutes into the
If only someone taught classes on execution and order management and position management. If only you could find someone who would, let's say, mentor you in those types of things. Perhaps hold your hand through the dark hours of the market and even wipe away your tears that night. You offer that service, don't you?
That's why I'm here. That's exactly right. We actually, we're really excited about kind of everything going on. I'm actually going to
Isn't your subtitle a shoulder to cry on?
That's what we do. Well, we like to suck a beer to cry into.
A little more manly.
Exactly. But, yes, that's exactly what we do. So if you want to learn, if you're looking for somebody that you can bounce strategies off of, I'm your guy. So that's kind of one of the things I
set that up beautifully for you, and you almost dropped the ball. Almost.
I almost did. But no, I'm your guy. If you're looking to learn how to do this stuff, or how to manage these positions, or if you just want somebody to poke holes in your ideas, that's what people pay me to do.
Always fun to poke a few holes. And Don, before we go, we always like to check in on what's going on, what's new, what's exciting over in the world of Volex.us. And I believe the last time we spoke, we were contemplating the idea of implementing some sort of ARB ratio calculator on the site. Obviously, it's only been a week. You guys have quite a few other things to do, so I'm assuming that isn't up there. But anything else going on at Volex.us you want to let our listeners know about?
No, I think our webmaster, who works tirelessly to try to put out as many applications and as much information as possible, has been working on a very big project lately that's going to get spreadsheets and all historical information with our indices, with all the settlement prices, with the partial vols, the forecasts, onto pages and sheets that will eventually be available in Bloomberg. And obviously, with the kind of dissemination and worldwide reach that they have, having all of the historical information for vol contracts available on Bloomberg is really very important to us and a very big project. So we are trying to put the finishing touches on that, and soon will be available for all people who have a Bloomberg terminal to be able to bring up these pages with all of the information that we think eventually, as we talk about bringing out products on equity and other underlying assets, will be extremely helpful not only to traders, but to researchers and to people who want to back test various systems and approaches, all the kind of things we've been talking about today. You really need access to that kind of information, and knowing that it would soon be on Bloomberg is something that we're working towards making a reality.
Your poor webmaster, he must listen to this show and cringe every week because we always throw out new ideas and new things for him to work on.
I don't even know if he has time to listen, but...
Oh, those guys, those two, Don and Mark, ranting off again, but what else I need to do here? I'm working on Bloomberg, guys. Leave me alone. But yes, that is going to do it for this episode of Volatility Views. I want to thank all of you out there for downloading and streaming and subscribing to the show and making it such a success. And we'll see you all next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments, and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.